Great. So we are told here, Chuma Limited, it's May 2015, question number 1B. Chuma Limited is considering replacing a machine. The existing machine was bought 3 years. Ago. Actually, I was wrong somewhere there. Was bought 3 years ago at a price of 50 million. The machine is expected to have a useful life of 5 more years with no scrap value at the end. So meaning that the total useful life of this machine is how many years if you're following? We bought it 3 years ago, right? And we want in this case here to have it, we'll have it for 5 more years. So 8 years, you're right. So we have them. The machine could be disposed of immediately at 35 million. The new machine will cost 80 million with a useful life of 5 years and an expected terminal value of 5 million. With the introduction of this new machine, sales are expected to increase by 25 million per annum over the next 5 years. The contribution margin is expected to be 40% and the corporate tax rate is 30%. They have given us tax there. They've given us tax there. So the operation of the new machine will also require an immediate investment of shillings 8 million in working capital. Installation cost of the new machine will amount to 6 million. So depreciation is to be provided for on a straight line basis. The company's cost of capital is 12%. So because they have given me a rate of tax there, the very first thing I should do as a bright student is to calculate what? What should I calculate very fast? Because they have given me, ladies and gentlemen, a tax there. They have given me a tax there. They've given me a tax there. Is there somebody who can tell me in this case here what we are required to calculate? What we are required to calculate? Depreciation, isn't it? Depreciation. So in this case here, could you kindly give me depreciation per annum for the new machine? You know, there are 2 machines, so you have to calculate 2 depreciations. So give me depreciation per annum for the new machine. Depreciation per annum for the new machine. Because they have given me tax, then I have to calculate depreciation for each machine. So we start with the new machine. So new machine, in this case here, tell me, what are we supposed to take? I should take it straight line. I should take this minus this, divided by what here, somebody? Divided by what? Yeah, so please give me the depreciation very fast there. Is there somebody who is able to give me these figures for the new machine? Check the new machine. Check out the new machine. Check out the new machine. These guys don't want to give me the depreciation, and today we are moving with speed. Share the question. Somebody should be able to share the question. They're saying it should be 15. Check this. This new machine, what is the cost of the new machine? What is the cost of the new machine? Cost of the new machine, please don't forget this. Cost of the new machine there. The cost of the new machine they're telling us is 80 million. The new machine will cost 80 million, right? But remember, there is an installation cost. There is installation cost. Installation cost over how much? Which has to be capitalized. Installation cost over how much, which has to be capitalized. Pata potea. This you have to give me. Installation cost, installation cost of the new machine will amount to how much? 6 million, isn't it? 6 million. So in total, the new machine will cost us 86 million. And therefore, ladies and gentlemen, depreciation here will be equal to, we shall take the cost of the machine, the new machine, minus any scrap value. Are you able to see a scrap value there? Are you able to see a scrap value there? Are you able to see a scrap value there? Are you able to see a scrap value? Yes, for the new machine, they have told us in paragraph 2, the new machine will have a scrap value of 5 million. 5 million all over the number of years. The number of years they're telling me, how many years are we talking about? How many years are we talking about here? How many years are we talking about? 5 years. So then could you kindly give me this figure? 86 minus 5. 86 minus 5 equals whatever we get, we say divided by 5. And then you give me an answer. The mistake I normally see students doing here, ladies and gentlemen, is the fact that, number one, they will never remember to include the installation cost. Most of the students, I don't know why. Like Sherilyn, you had left installation cost. Please don't forget that in an exam. It's always part of what the initial cost. It's always part of the initial cost. The other thing that I've never understood why students bring it here is the concept of what here? It is the concept of working capital. You cannot bring working capital for depreciation calculations. We don't do that. We don't do that. So we have here the cost, the depreciation of the new machine. Thank you so much. Thank you so much. I'll use this later. I'll use this later. Now from there, I would want now a very good student to go ahead and give us depreciation of the old machine. Let's see. Depreciation per annum of the old machine. I'm giving you exactly 3 minutes. Depreciation per annum of the old machine. Let me see. Again, 3 minutes as a trick. I would want to see whether you guys will be able to see it there for 3 minutes and ensure that you get it right. Three minutes are over. 3 minutes are over. What do we have there for the old machine? For the old machine, I know the mistake that most students will do there. I know the mistake that so many. Give me your answer. What did you get? Yes, Fatima says 6.25. Someone else in this case here could do 10 million. Sharon, where did you get 10 million from? 6.25. Sharon, tuangalie ulikosea wapi. Ukiangalia vizuri hapa, hawaja kupatia. Unajua kama ingekuwa, for example, you're getting net book value using reducing balance. That is where we normally have a problem. But otherwise, ladies and gentlemen, here what we should do, they have told us here for the old machine, Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of 50 million, The machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. The machine could be disposed of immediately at 35 million. That disposal figure of 35 million immediately will always confuse students. Ladies and gentlemen, just use the normal depreciation here. So depreciation formula, we shall take here the initial cost is 50. Fortunately, there is no installation cost, which was in a card to put this up, right? They have told us the scrap value is still what here? 0, right? And then, of course, we have in this case a number of years are how many? They are 8. In total, the useful life here is 8. So 50 minus 0 divided by 8 gives me what? Somebody there. 50 minus 0 divided by 8 gives me how much here? Somebody per annum. Right? 6.25, isn't it? 6.25. Somebody can come and consider that after 3 years, we did a revaluation. Somebody may also make that argument. Somebody may come and tell you that after 3 years, we did some revaluation. There is no problem. When there is revaluation in accounting, what should we do? No problem. Then what I'll do, I'll come and get, in this case here, accumulated depreciation for 3 years. So for 3 years, already we have the depreciation per annum, which is 6.25, right? Times 3. Can somebody in this case here give me 6.25 times 3? 6.25, what is the total depreciation for 3 years? 6.25 times 3. Right, please, speed is of essence today. Speed is of essence today. 18.25, thank you. 18.75, thank you very much. 18.75. So then in this case here, by the time we are doing this revaluation after 3 years, at the end of the 3rd year, what should be the net book value? What should be the net book value? The net book value, remember we bought this asset at 50. It has cut value by 18.75. So what is the net book value? What is the net book value? 50 minus 18.75 gives me what net book value? It is the cost, the new 31.25. So this is like the cost that we are starting with on the 3rd year, moving forward now. If you use then this approach, the depreciation per annum will be this net book value at the end of year 3, right? They will still maintain that the scrap value will be 0. But now the remaining useful life in this case is how many years? Is 5 years. Remaining useful life is 5 years. Remaining useful life is 5 years. So that the depreciation per annum will be equal to what? It will be still the 6.25. I know why I have used this second approach. This second approach is very important because this guy will come and tell you that when they bought this old machine, right? They had projected, ladies and gentlemen, too. They had seen in this case here that the scrap value was to be zero. So initially, the scrap value was estimated to be 0. But now they have come here, they are realizing that this thing is not going to be a scrap value of 0 at the end of the day. After 3 years, they do some check. When they do some check, they realize that now there is a resale value, not resale, but there is a new scrap value, like of 20. If this scrap value was to change, then the 6.25 would have not been the depreciation per annum. Right? I'll be able to show you this kind of approach that I'm talking about for it even to sink better, but at least we've been able to get the depreciation. Can we make a small comment there that we computed depreciation simply because tax has been given? We computed depreciation simply because tax has been given. If tax wasn't given, then automatically we will not have calculated the depreciation. Now, let's now move forward. This is an interesting question. We are told here, paragraph number 3 now. Paragraph number 3, paragraph number 2 still. The new machine will cost 80 million with a useful life of 5 years and an expected terminal value of 5 million. With the introduction of the new machine, sales are expected to increase by 25 million per annum over the next 5 years. So I'll use this benefit, the benefit there, to calculate the cash flow per annum. I'll use the benefit, ladies and gentlemen, here to calculate the operational cash flow. Let's calculate the operational cash flow per annum. Let's calculate the operational cash flow per annum. Right, Ndilo is saying straight away, we have our benefit. Our benefit for bringing in the new machine, it is the increase in sales. It is the increase in sales. So the increase in sales is the benefit. And they have given us a figure of what here, somebody 25. Is that true? They have given us a figure of 25. When you bring the new machine, then the sales of the company will increase by 25. Is that correct? Is that the position? Right, and remember that's an annual figure. And then in paragraph number 3, they have given us the contribution margin. They have given us the contribution margin. Whenever I'm given the contribution margin, then I should use it to get the total contribution. Give us the total contribution then to be expected by bringing in this new machine. Who can tell me? They have given me a contribution margin of 40%. Who can tell me what am I going to do to be able to get the total contribution out of this? Total contribution out of this. I mean, I have the contribution percentages, isn't it? I have the contribution percentage, it is 40%. Times what here? Somebody 25. 40% times 25 years. I have the contribution percentage, contribution of sales. Yes, 40 times 25. Which gives me what figure, ladies and gentlemen? Which gives me what figure? 4 times 25. So this gives me 10 million. Now, once I get total contribution, remember cash flow normally comes from profitability. Once I have the cash flow, the next thing we should do is to think about profit. Hey, you students of management accounting, how do we get profits from contribution? What do we need to subtract? What do we need to subtract? What do we need to subtract from contribution to get, in this case, here, profit? Thank you so much. So come here and the less, the firm's what here? Fixed costs. Come here and the less, the firm's fixed cost. So the firm's fixed cost, you're subtracting the firm's fixed cost. There is no fixed cost that has been provided there associated with this new machine. No fixed cost. There is no place they have told us that there is an incremental fixed cost of nothing really there. So fixed cost there is 0. So please subtract whatever profit we shall get here. We shall call it profit before who? Depreciation and tax. The very first profit you get here is profit before depreciation and the tax. So 10 minus 0 gives me what figure? 10 minus 0 gives me what figure? 10 minus 0 gives me what figure? It is 10, of course. Now, having gotten this, we know that the next thing we should do is to come here and subtract depreciation. So you less depreciation. So remember, this has to be the increase, the incremental depreciation. It has to be the increase. You take the depreciation of the new machine minus the depreciation of the old machine, right? It has to be the difference because, you know, this is a difference. It's an increase in sales. So you want to know, in this case here, the depreciation will increase by how much? By bringing in this new machine, right? So, ladies and gentlemen, when you look at this question very well, they have told us, or rather we got these figures, if you remember, who can give us the depreciation of the new machine? The new machine depreciation is how much? Depreciation of the new machine, was it 9.95? 16.2, if you remember. So it is 16.2 minus depreciation of the new machine, which was, or of the old machine, which was it 6.5? 6.25. Thank you so much, 6.25. So remember now here you have got that 2 machines. Whenever you've got 2 machines, please don't confuse. Don't take depreciation of only 1 machine. It has to be the increase, the difference between the 2 depreciations. So the difference here gives me, they're saying it's 9 point. They're giving us a figure of 9.95, right? They're giving us a figure of 9.95. They're giving us a figure of 9.95. 9.95. So could you kindly then, ladies and gentlemen, in this case here, subtract for us. So try subtracting there. What figure are we getting? 0.05. Can we revisit this depreciation of the new machine? Let's revisit depreciation of the new machine. We see whether we are right. Let's revisit this new machine depreciation. What are we supposed to be having there as depreciation? Let's see, because I can see a figure of 17,100 depreciation of the new machine. Remember what we said for the new machine, we shall take the cost of the new machine, which was 80, plus the installation. Installation ningapi somebody? Installation ningapi? Installation 80 plus 6 million. 80 plus, so it gave us 86 million in total. Do we have any scrap value? Do we have any scrap value for the new machine? I think we forgot something here. Do we have any expected terminal value of the new machine? 5, So 86 minus 5 divided by what here? Somebody divided by The number of years. The number of years, ladies and gentlemen, the number of years here, the number of years of the new machine, which in this case here we got as what year? 5. Hebu jaribu tena mara mwisho abracadabra, 86 minus 5 divided by 5. Will you still get this 16.2? Will you still get this 16? Ah, great. So then 16.2 minus 6 point what here? 6.25, which gives us 9.95. Ladies and gentlemen, after we get this now will be profit. In this case here, before what year? This will be profit before what year? Somebody before tax. So go ahead and tax. So less tax. So when you subtract tax at 30%, please subtract tax at 30%. Subtract tax at 30%. Where do we get the 16.2 from? From here. 86 minus 5. Whatever we get, we divide by 5. We divide by 5. So less tax. Are you able to give us our tax at 30%? What are we getting? Somebody here. 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 Abracadabra. 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 Yes, tax they're saying is 0.035. They're saying that tax is 0.035. Thank you very much. Tax is 0.035. 0.035. So please subtract here to get profit after tax. Subtract here to get profit after tax. Subtract to get profit after tax. Profit after tax. I'm being given a figure of 0.015. 0.015. So once I've gotten profit after tax, what should I do? What should we do once we get profit after tax, 0.015? We need to come and add back what here, somebody? We need to come and add back depreciation, isn't it? Add back depreciation. So I'm being given that tax is 0.15. I don't know, 0.0. I don't know. Tax, please check here, check here. I'm being given a figure of a tax of 0.015. Thank you very much. So then when you subtract, you should be able to give us profit after tax. So profit after tax is the one that becomes what somebody here? 0.035. Thank you very much, 0.035. Now, once we have gotten profit after tax, of 0.035, come and add back depreciation. Add back depreciation of how much? Remember the figure that we heard? The figure that we had of depreciation, which is an incremental, is 9.95. So could you kindly add this for you to give us the operational cash flow? Could you kindly add that there for you to give us operational cash flow? So the operational cash flow, I'm being given a figure of what here, somebody? 9.985. 9.985. So the operational cash flow is 9.985 like that. The operational cash flow is 9.985. The operational cash flow is 9.985. So what have we learned here, ladies and gentlemen? Please, for the new machine, you bring the benefit. If they give you a contribution percentage, you shall be able to use the contribution percentage to get the total contribution. And then you less fixed costs. Whatever you get, it will be your profit, but profit before depreciation and tax. Then once you have that, please go ahead and less what your depreciation, and this depreciation has to be the incremental, all right? Now, once we have this, then we should be able to get tax, of course, profit after tax, and we add back like that. Now, ladies and gentlemen, I would want us, now we have gotten, we've got 3 types of cash flows here. We have cash flow at the beginning, we have cash flow at the end, and then we have now the cash flows in between the operations now. Could you kindly calculate for me the terminal benefit here, the terminal cash flow? I would want somebody, this figure, we should be able to remember it. I would want somebody to come and give me the terminal cash flow in a situation where we have got 2 machines. In a situation where we have got 2 machines, how do we get our terminal benefit? How do we get our terminal benefit? Our terminal benefit. Remember, terminal benefit, we have got 2 things. There are 2 methods, Mwaura. Remember, there are 2 methods. We could either try to use the depreciation tax shield, or we use this one, longer one. Let's be using the longer one always. Deduct depreciation tax. After all, there is no much in terms of difference, in terms of time saving. Nothing really. What do we do with the 25 million benefit? That will come later. Great. So I would want somebody in this case here to go ahead and give me the terminal benefits here, the terminal cash flows. So terminal cash flows, we normally have two things. Terminal cash flows, we have, yes, we have number one, we have the scrap value and the working capital. Don't forget this. We have the scrap value, and what here? Working capital. So is there somebody who is able to see any terminal benefit? Is there anybody who is able to see any terminal benefit? Please go to this particular note number 2. Note number 2, we have expected terminal value. So we have in this case here the scrap. The scrap, ladies and gentlemen, I will take 5 minus 0. It has to be the increase in scrap. Sharon is saying 13 million. Scrap value. Scrap value. Wanasema what 13 million is the scrap 13. Please go to note number 2. The new machine will cost how much here, somebody? The new machine, in this case here, will cost, we are told, 8 million. With a useful life over how many years? 5 years. And an expected terminal value over how much? 5 million. So scrap value of the new project there is 5 million. Is that okay? Yes. And then now we have the scrap value of the old machine. So please here, whenever we've got 2 machines, we always talk about the incremental scrap. You must subtract. The old machine scrap value was 0. So 5 minus 0, that gives me 5. And then you come and add, in this case here, what we call working capital. We add working capital. So the working capital has been provided in the question. The working capital has been provided in the question there. Working capital, ladies and gentlemen, working capital, we have been told in the question is 8 million. Working capital is 8 million, giving us what here? 13 million in total. So you add working capital, that will be released to you. So you are through with this. Now we go to the last working, which is a cash flow at the beginning. Cash flow needed at the beginning. So please come here and give us the initial outlay. Na hapa ndio abracadabra wanafunzi wengi hawapatangi. Initial outlay ndio shida. Utaweza kweli. Initial outlay ndio wanafunzi wengi inakuwa international what ya disaster. Initial outlay. So for the initial outlay, somebody has already gotten 47 million. So we have your purchase cost plus any installation. Thank you very much. So for the new machine, ladies and gentlemen, what do we have here? Remember, it's the initial outlay now needed to procure this machine. So in this case here, listen to me, initial outlay, you have to be very careful. We have the cost of the new machine, cost, you've given me a figure of 86. Is that true? New machine cost, you've given me 86. Is that true? Great. That's very important. Now, if I want to buy this new machine today, I must sell the old machine. Now, this is the biggest difference. If I buy a new machine today, I must sell the old machine today. So I will get some kind of what here, like a waiver, like some help there. So in this case here, come under less disposal of the cost, less disposal value, less disposal value of old machine. So are you able to see the disposal value of the old machine somewhere? If we are to sell it today, don't work with scrap here. If you sell it today, it will be 35. So ladies and gentlemen, could you kindly go ahead and guide me? In this case here, what do we have here? Or rather, you can still, there is something here that so many students will always forget. Whenever you've got 2 machines, when you sell the old machine, there will be some gain or a loss on disposal. This is something that so many students don't bring up here. When you've got 2 machines, there will be some gain or a loss on disposal. Very few students can get this correctly, but I know you guys will ace this. We have sold the old machine. What in this case, ladies and gentlemen, will be the gain on disposal. What I'll do for the old machine, I would want someone to give me the net book value at the point of disposing. So please come and give me the net book value at the point of disposing this old machine. Is there somebody who can, because we have to remove depreciation, we have actually obtained this figure. So the net book value of old machine at the point of disposal, Mnakumbuka hii figure kweli? Hii figure mnaikumbuka ilikuwa 31 point what here somebody? Ilikuwa 31.25. Hii figure ilikuwa ni 31.25 like that. Now remember, you'll be forced to come and open what we call a disposals account. So this disposals account, if you remember, when you dispose a machine, what do? You go to the machine's account, credit the machine's account with net book value. You credit the machine's account with net book value. You bring that net book value to a special account called disposals and debit here. So that we have in this case here net book value 31.25. That's very important. From there, the second step in disposals, we shall receive the money. When we sell the asset, how much are we being paid? This old machine, when we sell the asset, how much shall we get? 35, isn't it? So the 35 million, I will debit my bank account, I credit disposals account. So come here and credit this with bank. So bank 35. Is that okay? So net book value is 31.25. And then the bank, in this case here, is 35. So ladies and gentlemen, could you kindly tell me here, what do I have at the end of the day? Am I going to make a profit? Or a loss in this transaction? It's a profit, isn't it? I'll be able to explain that. I can see a profit because the balancing figure is coming here. So this is 35, this is 35. So I shall be able to credit my profit and loss account. What is the difference? Profit and loss account, 3.75. Remember, this figure is supposed to be a deduction. This concept of the old machine, new machine is very common and very confusing. If the examiner wants you to get a 0, this is what he'll easily bring, right? The two machines. So Kendi was asking, how did we get this 31.25? No problem. I'll be able to demonstrate this. Remember, this is as pertaining note number one, where they told us that Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of 50 million. The machine is expected to have a useful life of 5 more years with no scrap value at the end of its useful life. So in this case here, for the old machine, I will first of all calculate the old machine's depreciation before even talking of the 3 years, the normal depreciation. Remember depreciation straight line, you take initial cost, scrap value, 0. Divided by number of years. Remember, this machine was acquired 3 years ago. And now we are talking of 5 more years. So in total, the machine has got 8 years. So can somebody again remind me, this 50 divided by 8, I think this is what gave us a 6.25 per annum. So then what is the accumulated depreciation? For those 3 years? It will be 6.25 times 3 years, which gave us something 18 point something. Accumulated depreciation gave us 18 point something. So 6.25, yeah, 18.75, thank you very much. So this is the total accumulated, or rather value lost for the 3 years. When I'm trying to make some changes. So now, ladies and gentlemen, once I have this accumulated depreciation, the next thing I'll do is to come and give them the net book value at the end of year 3. When I want to sell this machine. So the net book value will be the initial cost, which was 50, minus this accumulated of 18.75. This is how we got the 31.25 like that. By the time we are selling this machine, it's worth 31.25. So this 31.25, we need to write it off our books. So we credit our machinery account, we debit our disposals. And of course, you must have seen how I got now the profit. Now, ladies and gentlemen, what will happen with this profit you have obtained there? What will happen with this profit here is to come, ladies and gentlemen, and do what here, pay tax on it. Initially, you have sold the machine, you have made a profit. According to the assumption here, you must pay tax there and then. So there is a cash outlay, right? So give us their tax on gain, on disposal. You guys have given me a gain of 3 point something. I've forgotten the figure. You guys gave me 3 point what here as the gain? You guys give me 3 point something here as the gain, 3 point something here as the gain, 3 point something here as the gain. You give me some figure here as the gain. It's a figure you guys gave me, 3.75. 3.75 as the gain. Remember, our rate of tax is 30%. 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 What are we able to get somebody here? So they're giving me a figure of 1.125. They're giving me a figure of 1.2, 1.1, because I'm paying. Remember, this is an outlay for us. I'm paying this money, right? It's a cost. It's a cost. So cost, you can see costs here are positive. Costs are positive. So leave it like that, positive. There is something else that so many students will forget. The concept of WC, add working capital. Add working capital. Working capital amount ilikuwa ngapi? Somebody if you remember. Working capital amount ilikuwa ngapi? 8, isn't it? So and that is it. Can you take this minus this plus that? Give me the initial outlay. Quite complicated, but the most important thing is the low-hanging fruits. The low-hanging fruits. The low-hanging fruits. So I'm being given a figure of 60.125. I'm being given a figure of 60.125, and that is our initial outlay, 60.125. Now, lastly, please go ahead and give me the net present value. Please now give me the net present value. What do we have there as our net present value? What do we have there as our net present value? Our net present value will be equal to who? Our net present value will be equal to who? Please give me the net present value. Give me the net present value. To get the net present value, I will take my operational yearly cash flow. Operational yearly cash flow, you guys had given me a figure of 9 point something. You guys had given me a figure of 9 point something. My NPV, my operational cash flow will come and even 9 point something, if I remember. 9.985. 9.985 times PV5. 9.985 times PV5. Yes. Do we have any other? Do we have any other type of cash flow? Do we have any other type of cash flow? Yes, we do. We have some other type of cash flow. There is a cash flow we called the terminal benefit. The terminal benefit. Terminal benefit. And terminal benefit, if I remember very well, somebody had given me a figure of 13. Somebody had given me a figure of 13, isn't it? Yeah, 13. And this is a one-off figure. This is a one-off figure that I need to come and multiply it with what here somebody with PV, right? Now minus the initial outlay, which is 60.125. Remember PV, or rather initial outlay, we don't discount. Initial outlay, we don't discount. Initial outlay, we don't discount. We don't discount. There's a question there. How did we get this 1.125? You know, we got the benefit there. Yes, the 1.125 should be added. The 1.125 should be added. You know, this is basically a cost statement. When it's a cost statement, costs are positive, benefits are what here, negative. It's a cost statement. Once we have realized a profit on this particular item, what shall we do? We shall be required to pay tax. So that tax payable is a cost. Just like how this 86 is a cost for us, we shall be able to pay this cost for the new machine. Just like this working capital is an outlay, but we are maintaining it as a cost, as positive. So here we are saying that all costs to be positive and the benefits in this case have to be what here to be negative like that. So we get the initial cost in lump sum. How much do we need? It is 60.125. And then now the entire amount will be treated as what here now, an outlay, and that's why we are subtracting. So has this examiner given me the cost of capital? Has this examiner given me the cost of capital? Has the examiner given me the cost of capital? Has the examiner given me the cost of capital? Yes, 12%, isn't it? 12%. Thank you so much. 12%. So in this case here, come here very first. What do we have? We have 9.985. So we have here 9.985 times, of course, I'll calculate this. PV for 12%. Remember, we are working with the time of the new machine now, 5 years. If we have it on the table, we simply read. I'm so sure 12% is there. I'm so sure 12% is there. It's PV for 12%. If we have it on the table, we read. If we have it on the table, we read the answer. We read the 36,048. So here we have 36,048 with a decimal there, plus 13 times. How about this PV? Please go to the lump sum tables. Go to the lump sum tables. This is not an annuity. This is not an annuity. 5674, 5674, 5674 minus 60.125, minus 60.125. So then we shall be able to get net present value. We shall be able to get net present value. We shall be able to get net present value. So in this particular case, what are you guys able to get as our net present value? What are we able to get as our net present value? Somebody is saying it's negative 16.7549. Negative 16.75, yes. Negative 16.76. So NPV is negative 16.76 like that. Negative 16.76. Negative 16.76. So of course we reject. We shall not buy the new machine. It is coming with a negative net present value. It's not worth it. It's not worth it. It's not worth it. So as a quick recap, when you are given two machines, old machine, new machine, what are your key takeaways? What are your key takeaways? When you're given old machine, new machine, what are your key takeaways from this particular computation? You may not get everything really. You may not get everything. So depreciation, and it has to be incremental depreciation, right? Right, right, right. The other thing that I would want you please to be very keen about, you must always look at that gain on disposal. That gain on disposal. So everything here is about what here, somebody? Incremental. Even working capital. If, for example, you're given working capital of the old machine, and then we have working capital of the new machine, you must always subtract. If there are two scrap values, scrap value of the old machine, scrap value of the new machine, you must always do what here? Subtract, right? And then, of course, the most important thing, don't fail to write anything in that exam regarding this particular type of a question, because there is like a PVF. There is like what here? A PVF. Very good question there. Very good question there. What if in this case here we have a loss on disposal? What do you guys know about losses in terms of taxman? The taxman normally taxes everything, isn't it? Yeah. So you would have taken 30% of that loss. However, this time round it would have been a benefit to the company. Yeah, you would have subtracted. Good question, you would have subtracted. For us, remember, don't forget these basics as we get to an exam, Lily. Don't forget these basics as we get to exams. Don't forget these basics. Remember what we said in our normal class. If, for example, you're given profit before depreciation and tax, say, of 10, and then we have depreciation of, say, 5. We have depreciation there of, say, 5 like that. Sorry, not 5, 15. Now, could you kindly give me the profit here? So profit before tax will be minus what? Minus 5, right? Right. Profit before tax will be minus 5. So please go ahead and less what here? Go ahead and less tax. So when you less tax at 30%, tax minus 5 times 30% gives me minus what? Somebody please help me here. 30% times minus 5 gives me what figure? Minus 1.5, minus 1.5, minus 1.5. So even if it's a loss, you must always nyorosha your tax rate. Lazima nyorosha your tax rate, even if it's a loss. And then now remember, we are taking this profit minus this. So itakuwa minus 5, minus this. So 2 minuses in between there. Then we shall be able to get what we call profit after what year? Profit after tax. Yeah, profit after tax. I'm being given minus 3.5. Is there someone else who's getting minus 3.5, isn't it? So minus 3.5 like that. Having gotten this, then I should be able to come and add back depreciation, remember. So come and add back depreciation. Come here and add back depreciation. Depreciation. Over how much here, somebody? We got this depreciation of 15. Then we'll be able to get what we call cash flow. Cash flow. So cash flow hapa itakuja kuwa ngapi? Wanasema itakuwa 11.5. 11.5. Itakuwa 11.5, which would have easily gotten by taking this approach. Useme tu cash flow equals profit before depreciation and tax, right? Go ahead and tax, right? And then you add a depreciation tax shield. All right. So then, ladies and gentlemen, this one here will be what here somebody would have been. I would have taken this 10. Tax is 0.3. So then this will be 0.7 plus depreciation itself, which is 15, right? Times the tax. The rate of tax is 30%. Can you kindly confirm that this will give us this figure of 11.5? The cash flow. Can somebody confirm? Can somebody confirm that this will give us that 11.5? Yes. So hata kama for example, ladies and gentlemen, umepata loss, sisi lazima uchape tax. Lakini unajua ideally, unajua hapa inakuwa minus. Hii ni kama unapata tax waiver when you make a loss. When you make a loss, it's like you get what here. My question is tax on disposal loss. Do you still add to? I'm not getting this really. Now, assuming, for example, to simplify this question here, assuming in this case here we have our net book value, or rather this is disposals account, assuming we have our net book value of 31.25, but assuming in this case here we are paid a cash of 28, then automatically we shall make a loss. A loss of how much? We shall make a loss of how much? Yeah, we shall make a loss of, I've already seen that. We shall make a loss of how much? So take 31.25 minus 28. What shall we get? 3.25. Loss, isn't it? Loss. So then what will happen here is that we have our initial outlay. Our initial outlay here was what here? Somebody was 86, right? What else we have in this case here? Benefit of selling the old machine. So sales proceeds, old machine. In this case here was 35. We subtract like that. Now we have a benefit on tax. The benefit on tax because of what here? The loss. So it will be 30% of what here? Somebody 3.25. So 30% times 3.25 gives me what figure, somebody? 30.25 gives me 0.975. 0.975. You see now this is a benefit to the company. It's a benefit to the company. So now we can't add it. It's not a cost. It's a benefit. Just like how we had this benefit of selling the machine. So now this has to be done what here? This has to be subtracted. This has to be subtracted. Right? This has to be subtracted. Now, I can see, ladies and gentlemen, there, you guys are asking about installation cost of 6. Installation cost of 6, tumeongeza kwa ama tulisahau kuongeza. Hiyo ilikuwa, initial outlay ilikuwa ni 80, na kulikuwa na installation ya 6, ndio ikakuwa 86. Right? I've seen, okay? Great. What of the increase in sales? Increase in sales, yes, that one we were able to take it as a benefit. So we used increase in sales of 25 million, and then we were able to get the increase in contribution by taking 40% of that, right? And then we did the statement. Maybe Meru ulichelewa kidogo. Great. Now, ladies and gentlemen, there is one question that I did for you here. Sijui kama mko nayo video yake. There is one question that I did for you here. Do we add incremental working capital in initial outlay? Incremental working capital in initial outlay. Yes. Assuming, for example, we had a working capital for the old of say 10, and then a working capital of the new of 15. Then the working capital that should come here should be the increase. Great. Now, ladies and gentlemen, there is one good question that I did for you. Kitu iko na reducing balance method. Reducing balance method. Reducing balance method. I've seen what Charlene is asking there. Reducing balance method. Reducing balance method. Reducing balance method. There is one question that I did for you some time back here. Are you guys good with calculating depreciation using reducing balance method? Because when you miss your depreciation figures, then in the entire question, you get a 0. That is the most unfortunate thing. You know, students fail in AFM because of this question, your NPV. No, I done this question, and I remember there is even a video. There is a video that we had I done this question for you. Na niswali ya ACC mzuri sana. Power N. Let me show. Perhaps it's because you don't know the question I'm talking about. Let me show you the question. Let me show you the question because I have a video. The trigger company plans to buy a new machine to meet expected demand for a new product, product T. This machine will cost $250 and last for 4 years, at the end of which time it will be sold for how much? $5,000. Trigger company expects demand for product T to be as follows. So you can see they have given us that information. Most importantly, they have given me tax allowable depreciation of 25%, and they have given me tax of 30%, right? Look at this. It can claim tax allowable depreciation on a 25% reducing balance basis. Hii ni kitu hatari sana hii. Hii ukicheza unapata 0 in the entire question. Hebu tufanye depreciation peke yake. Let's try doing this depreciation. Hata sio ngumu, ni rahisi, ni rahisi. Hii kila mwanafunzi anaipata vizuri sana. Kila mwanafunzi anaipata vizuri sana. Hii hakuna mwanafunzi anaweza akakosea hata mmoja. Utashangaa sana. So what is the initial cost? What is the initial cost? What is the initial cost of this machine? Sorry. Take a screenshot. Please take a screenshot. Take a screenshot. Take a screenshot. 250, yeah? 250. Let's try to cut those thousands free there. 250. So have they given me the annual rate of depreciation? Have they given me the annual rate of depreciation? Have they given me the annual rate of depreciation? All right. 25%, isn't it? They've given me 25%. They've given me 25%. They've given me 25% here. Reducing balance, 25%. So no worries. So then what I'll do, depreciation per annum, 25%, reducing balance, like that. Great. So then we start, ladies and gentlemen, here with the initial. We start with year 1 depreciation. So year 1 depreciation without even those shortcuts, just take 25% of 250. Please give me an answer. Year 1, 25% of 250, please give me an answer. Whole number, I don't want decimals. I don't want decimals because mmenembea nifanya haraka haraka, isn't it? Nataka tu whole numbers. Mmenembea nifanya niwachana na mambo ya kwenda pole pole. So 63. Aya, twende year 2 depreciation. So year 2 depreciation itakuwa ni 25% of the reduced balance, which will be 250 minus 63. Ambayo itakuwa ngapi? Year 2, I mean. Whole number. Wewe utaweka decimal kwa exam, 2 decimal place. Mimi naweka whole number of 47. Aya. How about year 3? How about year 3 depreciation? 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 Year 3 depreciation, mnasema itakuwa ni 25% of the reduced. So reduced tulianza 250, tume lose 63 in year 1, tume lose 47 in year 2. So itakuja ngapi? Somebody is giving me a figure of 32. 32 ama 35. Eunice is saying 35. Marietta, umefanya juu kupata 32, figure tofauti sana Marietta sasa. Ama ni typing error, ni typo. 35. Aya, tuende kwa year 4. Remember the project has got 4 years. Year 4 depreciation. Hebu nipatie year 4 depreciation. Year 4 depreciation, nipatie year 4. Year 4 is the last year, remember. Year 4 is the last year. Year 4 is the last year. Year 4, Lily anasema 26. Thank you very much. You guys are very bright. Thank you very much. Terry amekataa. Eunice amesema 26. Kumbe ni vizuri mlisema tufanye swali kusema ukweli. Kusema ukweli mlifanya vizuri, wacha tufanye swali polepole. Kusema ukweli, mlisema tufanye swali polepole. Year 4 depreciation can never be computed using percentage because year 4 ndio ya mwisho. Hapa huwa tunasema balancing charge. Hapa huwa tunasema balancing charge or allowance, balancing. And there are two ways. The very best, don't apply percentage. Pick 250 where you began from. You lost 63 in year 1. You've lost 47 in year 2. You've lost 35 in year 3. And then because you never use the percentage normal to cram this, we come and subtract the scrap value. Scrap value. We're going to subtract scrap value. Are you able to see the scrap value in the question? Are you able to see the scrap value in the question? Are you able to see the scrap value in the question? Scrap value. The machine, scrap value is 5. So what have we said hapo na cram haraka dakika mwisho? Tumesema unachukua 250, unachukua year 1, what you lost in year 1, minus what we lost in year 2, minus what we lost in year 3, minus the scrap value for us to get the balancing charge for the last year. So the last year, guys are telling me the figure is what year is 100. Is 100. So now, are we in agreement first of all there? Are we in agreement first of all there? Are we in agreement first of all there? Yes. Pass. Sasa hii mwaka ya mwisho itafanya upate 0. Hii mwaka ya mwisho itafanya upate 0. Right? I would have preferred also to use this other shorter method ya kupata depreciation tax shield. I would have preferred nichukue hizi figure ni multiply na, but unajua hii ni tax in arrears. Itakusumbua. Haya, sasa the other concept which I would want you guys please to take keen note of is this concept of a real cost of capital. This is a very important concept here. This is a very important concept here. Wanakuambia tracker company has a real cost of capital of 5.7%. So whenever you're given this real cost of capital, there is a disaster in waiting there. It has to be adjusted. So when I'm given this real cost of capital, what should I think about? What should I think about? A good student, somebody, when I'm given real cost of capital, what should I think about? What should I think about? What should I think about? When I'm given real cost of capital, I'm not seeing charts coming. They're coming now. Thinking first. When I'm a real capital cost of capital is fake, I'll think about Fisher, I'll think about nominal. You guys are great. Thank you very much. I'll think about Fisher, I'll think about nominal. So then how do we get nominal? How do we get? Because real cost of capital, even if they're using the word real, that is fake to us. That's fake to us. So I would want to get the nominal. And remember now what the Fisher's equation is all about. Remember what the Fisher's equation is all about. The Fisher's equation, if you can remember, the Fisher's equation, if you can remember, the Fisher's equation, if you can remember, what tunasema 1 plus nominal equals 1 plus real into 1 plus inflation. Into 1 plus inflation, yes. Into 1 plus inflation. This is I. This is I there. I for inflation. I for inflation. So N is nominal. Please write this is nominal and this is real. And then remember that inflation is not inflation that is specific for products or for our variables, like inflation for price. No. This has to be general or average inflation, because I've always seen students who will come and tell you that, Mwalimu, our I, we have got 3 I's here. We have got 3 I's here. We have got 3 I's here. Like we have this inflation here, price, inflation. No. We have our general inflation is expected to be 5%. General has to be given always. For Fishers, you must be given general inflation. So then this 1 plus N here will be equal to 1 plus a real, umesema ni 0.057. 5.7%, isn't it? 5.7% into 1 plus inflation. General inflation meaning 5%, which is 0.05. So real, remember real, they have given us the real inflation here. They've given us the real inflation here. They've given us the real inflation here. Real inflation, wamesema ndio hii hapa. Real inflation, not real, but general. General inflation is 5%. Real cost of capital is 5.7. 5.7% is the same as 0.0057, like that. So I would want somebody in this case here to come and give me this figure. I would want somebody to come and give me this figure. 1 plus N. Hii, ukimultiply, chukua bracket, abracadabra, we are overcoming. So unasema into bracket 1 plus this close times open 1 plus this you close. So what are we getting there? Abracadabra. Dilo anasema ni 0.57. Dilo anapenda kuweka question mark mingi. Mbona hivyo Dilo? Accountant is supposed to be very patient because we'll be handling a lot of money. Tukwenda kwa ofisi hivi Dilo unaambiwa straight away pesa imeibiwa 20 million. Don't collapse because of blood pressure. No, you must know how to handle situations. Right? So, ladies and gentlemen, in this case here, remember here, they gave us 5.7%. Hiyo ndio napiga ma question mark mingi. Hapa 5.7% below 5.7%. Ukidivide na calculator yako itakuja aje? 5.7 over 100. Sitakuwa hivi. Mbona unaweka 7 katikati? Unaweka 7 katikati. Kwa hivyo itakuwa sawa na 1.057 times 1.05 like that. Right? So tuende kazi hapa sasa. Kwa hivyo 1 plus n itakuwa, if we multiply hizi tafadhali, multiply hizo mbili, oye. What do we have here? Oye. 1 plus n, according to Kenneth Cheruiyot, we have 1.10 1985. 1.10 1985. So meaning that n will be, unapeleka ipande ule mwingine. Itakuwa minus 0.10 1985, which will be 10.19. Koja. Imechukua wrong. 10.9, yakuna ya katikati ni 10.9. 10.9, which is 10.985%. So basically the cost of capital here will be 11%. The cost of capital will be 11%. So there, are we together, all of us? 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 So at least this one, you may sink the last minute. So I hope now I've been able, ladies and gentlemen, here to kukuamua nyinyi kidogo. I hope nimekuamua kidogo. And I hope sasa, hii mambo ingine mnawezana nayo sasa. Hii ya kutafuta cash flows za katikati. Hiyo sasa, it's my hope that everybody anaweza akafanya hiyo sasa kutafuta cash flows. Because now we have set everything correctly. Wanafunzi sasa wako sawa. So wanafunzi wako sawa, because also the other day tulifanya kitu ya tax in arrears. 1 year. So I don't think sasa hapo mbele iko problem. Atuko sawa. Wow, you're not okay. No, you're not allowed to round off like that. Where? Usiround off whole number, utapata mashida, utapata madhena. Am I the one who is confusing you? Do you want to tell me that sikufanya swali mara mbili? Am I the one who is confusing this? Ama ni nyinyi ndio mnasahau? Nyinyi mmeanza kusahau. I did it not once, not twice. Lakini sasa tumalize sasa sababu. Okay, tumalize haraka. Tumalize swali basi haraka sasa. Haya. Kichwa imeanza kuwa mzito. I'll give you a second, don't worry. Haya, sasa kwa kitaka tupate cash flows in revenue statement, unafanya revenue minus cost. Unafanya revenue minus cost, isn't it? So I can see they have given me quantities here. I can see I have the selling price. I can see I have variable cost. I can see I have fixed production cost. Hebu tuanze na kutafuta selling price per year for the 4 years. Selling price per year for the 4 years. Tuanze na selling price. So we have 1, 2, 3, 4. Haya, tuanze na selling price. No, tuko na 0 pia. Tuanze na selling price. Haya, selling price. No problem, Sharon, we shall overcome. Now, tumeshapita hapo za selling price, hata ni rahisi. Hata ushajua ni accountant mkubwa, sasa ushajua hii mambo. Wamekwambia the selling price for the product T is expected to be 12.0 per unit. And the variable cost of production is expected to be 7.8 per unit. Incremental annual fixed cost is this, will be incurred. The selling price and the cost are all in current price terms. Ukisikia jina current price inamaanisha current price, today's price. So that means that this 12 is a price that I should be able to put on which date, So selling price is current price, 12 there. 12. Current price is 12. Wanafunzi wengi, hii swali ikija, wataweka current price wapi? Hapa kwa 1. It will be very unfortunate because you will get 0. When they tell you kwamba the price given there is a current price, it is a today's price. You should put it at time 0. If they are silent, then you take it to time 1. Here they have told us that the price given here is current. And then they have given us the percentage to increase this with. They have given us the percentage to increase this with. Wamesema namna gani your percentage? Wamesema hivi, selling price will increase by 3% per year. 3% per year. So selling price will increase by 3% per year. So 3% per year, unaweza ukafanya kimother tongue. Ukija hapo useme E12 times 1.03 because of the increase ya 3%. Si ni kweli? Aya, hebu sema 12 times 1.03 inakuja ngapi? Lili anasema ni 12.36 like that, 12.36. Ukija year 2 niseme nini times nini? Year 2 unaweza ukasema hapa ni 12.36, you just have this growing times 1.03. Andika answer. Ama 12.73. Sijui kama ndio njia mzuri, ama ufanye hivi, unaweza ukakuja hapo ukiwa mwanafunzi ambaye una uoga, ufanye hivi But I think wanafunzi wanapenda njia ya kitambo. Useme raised to power 1, ile 12 useme times 1.03 raised to power 2, useme 12 times 1.03 raised to power 3, useme 12 times 1.03 raised to power 4. Sijui kama method gani ndio mzuri. Whichever. Yuko mwenye anapenda kuwobble, anataka afanye mwaka moja. Old is gold. Ya kitambo, sawa. Basi hebu nipateni figures. I also agree to some extent, yes. Because sasa kama ingekuwa 12 ingekuwa hapa, then you could raise it to 1 ingekusumbua. Old is better, yes. I also agree like that. Old is better. I like how Gladys anasema namna hiyo, ati heri kienyeji. Sijui anamaanishaje. So hebu nipateni hizi figures, tuanze tena hapa mwanzo. We shall overcome. So 12.36. How about year number 2? Year number 2, 12.73. Is there somebody who could be having year number 4? Year number 3, I mean. Year number 3, 13.11, 13.11. And then now we have the last one. The last one is supposed to be what here, somebody? The last one is supposed to be 13.51. Is it 13.51 or 13.50? I don't know. 13.5. Sasa zimetoshana. Tuweke yote. Tuchague 1. Now from there we have the variable cost T. Variable cost, they have given me a figure of 7.8, which is also current, but now it has to be grown. It has to be grown at what percentage? 4% per year. It has to be grown at 4% per year. Tuangalie tena 7.8 nimeifikiria tu ama iko kwa question. Sijui kama iko kwa question. This 7.8, this 7, yes, the variable cost, yes. But it's growing at 4% per annum. So is it possible then you wobble, give us these figures very fast? Wobble, at 4%. So I can see keeps gives me 8.11. And then number 2, ladies and gentlemen, number two, 4%, you keep on adding. So according to Paris anasema ni 8.43, thank you very much. Or 8.44, I don't know. 8.44 is popular. Alafu hapa tuko na nini? 8.77. Alafu year number 4 tuko na 9.12 like this. So you subtract to give us what we call contribution margin. So contribution margin, we normally take price minus what here? Price minus variable cost. You give us contribution margin. 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 So contribution margin. So contribution margin, you are subtracting. Actually, I know that this was just for benchmarking purposes, times 0. I'm not even interested with it. It was just for benchmarking. Could you kindly give me the contribution margin for year number 1? For year number 1, contribution margin is selling price minus variable cost. Minus variable cost, 4.8 from Marietta Mutunga. Wengi wasemi hivyo. 4.25, thank you very much. Yeah. How about year number 2? Year number 2 contribution margin ni wanasema ni 4.29. Year number 3J ni 4.34. Year number 4J 4.39. Thank you very much. Now, ladies and gentlemen, having gotten this figure, what do you think will be the next thing to be done? Could you kindly guide me, Saumu Sumba? What do you think in this case here? How did you get variable cost? Do you have a problem, Ryle, with your internet or something? Because if you have seen how we got price, variable cost is 7.8, right? And then variable cost is increasing here by 4%. So when we start straight away with 7.8, like now here, I'll talk of 7.8 times 1.04. That's how we got this. Ukienda hapa tukachukua this figure times 1.04. Yeah. Why cancel year 0? Because year 0 is normally initial outlay, right? Thank you very much. Year 0 is normally initial outlay. I'll be able to calculate this later. Here is na maana nayo. Ilikuwa tu ni benchmark. Na wanafunzi wameniambia mwalimu abracadabra hapa juu ametupatia quantity to be sold in each year. Quantity to be sold in each year. Quantity to be sold in each year. Wametuambia quantity to be sold in each year. The quantity to be sold in each year wamesema hapa ni 35 hapa. 35 hapa tuko na 40 hapa tuko na 50, hapa tuko na 25. Oye, sasa kujeni hapa munipatie total contribution. Kujeni hapa munipatie total contribution. And you can see what these students are saying, that we should take, in this case here, contribution per unit times number of units. We are taking contribution per unit times number of units. Contribution per unit times number of units. C. So uchukue hapa hizo units tuko nazo, hizi ndio x. Hizi ndizo x. Sasa nataka kunipatie figures za whole number. Ndio tuweza kumove haraka. Ndio nikuambie mambo mengine nataka kukuambia hapa sasa. 35 times 4.25. So then this gives me what figure, somebody? 35 times 4.25. I'm told by Roba is 149. 149 is a beautiful figure. And then we have year number 3. Number 2, I mean, how would I write this as 3? It's year 2. Year 2 is 172. Then year number 3, what do we have here? Somebody, year number 3. Year number 3 is 217. It's 217. And then we have the last one. We have the last one, which is 110. Now, you guys are the guys who are on the driving seat. Having gotten total contribution, what should we do next? What should we do next? Having gotten total contribution, what should we do next? Thank you very much. We less fixed cost. Na mnajua maneno mnakaa kuogopa tu bure tu. Mnakaa kujua maneno sana. Mnaogopa sana. Kwani mnaogopa sana? So fixed cost, wametupatia fixed cost ya ngapi? Fixed cost, wamesema fixed cost, ladies and gentlemen, fixed cost, wamesema fixed cost ndio hii hapa. Unaona hii 25. Lakini pia wamekuambia hata hii fixed cost bado ni current fixed cost. So lazima 25 ni ya time 0. So then I would want you to calculate it slowly with this growth rate, Ryle. Fixed cost is growing at 6% per annum. So are you able to give me, remember this is at time 0. So are you able to give me the fixed cost at time 1? At time 1 itakuwa 25 times 1.06C. 25 times 1.06C. 25 times 1.06 inakuja ngapi hiyo? Shiralini wewe namna gani? So 26.5 wananiambia Shiralini anasema kwamba tukiwa pamoja ni rahisi. No, mimi nakataa hiyo. Mimi nitawaombea sana. Uelewi kitu. Next one is 28.09. The third one 29.78. 29.78. The last one 31.56. Nipatieni mimi whole numbers. Sasa nipatie whole numbers sababu hapa tunasoma. Nipatieni whole numbers. Then I should be able to get profit before depreciation and the tax. Nipatie tu whole numbers haraka tumalize. Roban anasema I hope Roban Robert 123. Marietta yake alikuwa amepata 1, no problem, no worries. 123. 122 amesema mwalimu weka 122, acha maneno hapo. 122 ama hata 123. Marietta amesema ni 144. Hapa year 3 je tuko na nini? Somebody year 3 187. Alafu year 4 tuna nini? Year 4 tuko na nini? Somebody year 4 tuko na 78. Thank you so much. So now, having gotten this profit before return on tax, what do you think will be the next thing to be done? Yeah, we tax, isn't it? So we tax. Usiende hiyo procedure ya tax shield, hapana. Hiyo ni njia ya kisasa na nyinyi mmeniambia kwamba mwalimu kienyeji ni better. Ataki broiler. So tax, wamesema tax iko ngapi? Depreciation kwanza na depreciation kwanza. Hiyo method kwenda kuchukua ni method mbaya hii. Ni method ya broiler. We less depreciation kwanza. Do you remember these figures, ladies and gentlemen? Year 1 ilikuwa inakuja ngapi? Less depreciation first. 63. Year 2 je haraka. Year 2 je 47. Year 3 je. Year 3 ni 35. Year 4 je 100. Thank you so much. So una subtract kwa furaha, and then you should be able to give us what we call profit before who? Profit before tax. You should be able to give us the profit now before tax. Kwa furaha. Profit before tax. Hapo kuna year 1, year 2, year 3, year 4. So profit before tax naelezo wa kwanza ni 59 from Frida Kendi. The lady from Meru. 59. Year number 2 inakuja 97. The lady from Mtwapa. 97. Year number 3 inakuja 152. 152. Year number 4 minus 22. Year number 4 minus 22. Thank you so much. So we have subtracted the depreciation amounts which we had gotten in. If you remember, there is a working that we did up there. If you remember, there is a working that we had done up there. Are you able to see that working at depreciation? Yeah. So please come here and tax very fast. So have they given us the rate of tax? Have they given us the rate of tax? Have they given us the rate of taxation? Have they given us the rate of taxation? Have they given us the rate of taxation? To project question 30%. Thank you very much. But remember, it is 30%, 1 year in arrears. 1 arrears. So take 30% of 59, give me a whole number. 30% of 59, give me a whole number. 18, give me a whole number. And remember, 18 will not be paid in year 1, 18 will be paid in year 2. 30% of 90. Remember, they are the ones who have told us 1 year in arrears. They're the ones who have told us 1 year in arrears. Ando wamesema namna hiyo. 30% 1 year in arrears. Kama 1 year in arrears ingekuwa tungeweka figures on the same year. So sasa hapa tunafanya wobbling. Tunafanya staggering. Yani tax ya year 1 peleka mbele namna hiyo. Right? So 30% of 97 nakuja ngapi? Paris amestuka sana. Paris will overcome, don't worry. You'll overcome Paris. So nasema 29. Aya, 30% of 152, 30% of 152, 46. Aya, how about 30% over negative 22? Now we have to introduce year 5 to take care of this staggered taxation. Yote gari kiwobble namna hii itaanguka, unaona. So 30% of minus 22 gives me. So utapata mwanafunzi mwenye ajui sana akikwambia unajua sasa hiyo ni loss. Sasa hapa ameanza kujifanya mjuaji wa KRA. At loss can never be taxed. Sisi kwa finance lazima tax everything. Sasa yet tumesema ni whole number. Tumesema itakuwa minus what? Minus 7. Si lazima uandike kama minus 7. Lazima uandike kama minus 7 because in 30% of a negative number. Yeah, thank you very much. Abracadabra. What is the profit for year number 5? What is the profit for year number 5? Ooh, the profit here for year number 5, it wasn't there. It is 0. 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 Thank you very much. Now from there, ladies and gentlemen, go ahead and do what here? Go ahead and subtract. Go ahead and subtract. So to subtract, we'll be able to get what we call now profit after tax, which gives me 59. This minus this gives me what? Somebody here. As I said, you don't have to be sorry, really. Ni mimi niko na makosa kuambia unipe whole number. Kwa exam unajua utaweka whole number wewe. Kwa exam utaweka hiyo kama nipatia. Kwa exam utaweka whole, utaweka decimal. Mimi niko na uvivu tu ya kufanya namna hiyo 79. The next one hapa inakuja ngapi? 123. The next one nakuja ngapi? 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 68, Minus 68. Hapa ni abracadabra. If you please be very honest and put the signs. Put the signs for me for year number 5. Put the signs for me. Kama ni positive niambie ni positive 7. Kama ni negative niambie negative 7. Bila uoga. Bila uoga. Abracadabra, hata mimi kwa exam, what I normally do, inabidi niandike kando saa zingine. Yaani nasema pongo minus 7. Unapo minus itakuwa positive. So inakuwa positive. Sababu kwa sasa tena hapa examiner wa AFM amini mbaya anapenda kuangusha watoto kwa hii question ya net present value sana. Kama error kadogo, you're gone. Inakuwa international disaster. Unaanza kusema kwamba umerogwa. Hakuna kurogwa. Hakuna kurogwa. You only miss out on the negative here. Sasa unakuja unasema add back what ya somebody? Add back depreciation ni. So depreciation ya ngapi? Somebody add back depreciation. Nakumbuka ni mbaya. Yes. Add back depreciation. Nipatie figure haraka ya 1 ilikuwa ngapi? Check, ngoja kidogo. Check profit after tax for year number 4 from the car. Profit after tax for year number 4 iko na shida. Hii. For year number 4, unajua ni minus 22, right? Hii ka minus, right? 46. Itakuwa sawa kabisa hiyo minus 68 in the car. The car angalia tena itakuwa sawa. Because you see what we are doing here, we are taking the number that is here minus. Remember there is this minus, profit minus tax. Right? Yes. Again, Mayomi is very right. Mayomi is very right. This is again where most of your time will be consumed. So you have to be aware, however good the question looks like, you have to take a maximum of 40. Yana tukienda sana, ila ambao umekosea sana. Maybe 45 minutes in a question. Right? And please, ikiwezekana kwa exam, some exam rooms hazina saa. It's important you buy your own watch. Very, very important. Iko mwanafunzi hapa ashafanyia exam room ambayo haina saa. Ashafanyia exam room ambayo haina saa kabisa. Yes. So unapata shida sana time. Wewe unaenda kwa supermarket, aka small ka watch namna hii, utapata kitu 300. 300 utapata kitu 300, 400 kona. Waliwatoa wristwatch, what do you mean? So then which watch should we use really? Ama utoka na moja nyumbani, umwambia hang huko juu. Hang for everybody. What do we do? What do we do? Invigilator. Hapana. Because what I know katika hizi paper zote, by the way, hizi paper zote, let me tell you something here. Let me tell you something here. Okay, so we have here 63, right? Here we have number 2. What do we have? Somebody number 2. 47. Upper J number 3. What do we have here? Number 3. Number 3, 35. Number 4, 100. Upper, of course, nothing. So please come and add for us. Give us, in this case here, what we call the cash flow, operational cash flow. These are operational cash flows. So operational cash flows, what do we have here? Somebody operational cash flows. 122, the first one. 126, the second one. Number 3, what do we have there? 158, the third one. Number 4, what do we have there? 32. Is it 32 or 132? 32. And then we have the last one, which will be what, somebody there, which will be 7. Thank you so much. So remember, these are operational cash flows. So what should I add to operational cash flows? Depreciation, no. Terminal. Add the terminal cash flow. Scrap working capital. Add terminal cash flow. So terminal cash flow, are you able to see them? In most cases, it is a scrap. Actually, remember there is a scrap of 5. There's a scrap of 5. So where should I put this 5? Can I put it in year number 5? Year 4, isn't it? Year 4, because the machine was going all the way to the 4th year. The machine was going all the way to the 4th year. Year number 5 is just a by the way. The units in this case here produced, the units that were produced, these units here, these units produced, perhaps below you have a problem with your network. These units produced. Can somebody in this case here tell us these units here which were produced? How did we make use of them? After we got contribution per unit, we multiplied. If you remember, if somebody can even take a screenshot of this and then you circle them for below, you post them there. We used them. Yeah, to get total contribution, yes. Thank you so much. So then we have our terminal cash flow here. So we'll be able to get our total cash flows again. So we'll be able to get our total cash flows. So our total cash flow here, we have 122. Here we have 126. Here we have 158. Here we have 37. Here we have what here, somebody? We have 7 like that. So now from there, you guys should be able to give me the PV if we discount. PV at what rate? Do you remember our 11%? Do you remember our 11%? 11%, the nominal, isn't it? The nominal. Abracadabra PV, 11% sana sana iko kwa table. 11% hapana iko kwa table. 11% haiwezi kuwa kwa table. So remember what we shall do here, ladies and gentlemen, is to use the formula that our PV will be equal to 1 plus R raised to negative n. So it will be 1 plus 0.11 raised to negative n. So it will be 1.11 ama ya kwanza raised to minus 1. Yeah, I can see associate giving me 0.9009 for year 1. Raised to negative 2, is there somebody who has something for year 2? Raised to negative 2, is there somebody who has something for year number 2? Saumu leo, Saumu amenyamaza. Saumu sijui ni baridi mingi Saumu ama namna gani? Si kawaida yako. Ama the higher you go, the cooler it becomes. 8116. Kuna wanafunzi wengi siwaoni hapa kabisa wakiongea leo. Totally. Kama Willy Velma anaongeanga sana leo. Simuoni. 7312. But I hope we are together. In operational cash flows. Okay. So kuja hapa kwa year number 4 kwanza nipatie figure. Kuja kwa year number 4 nipatie figure 6587. 0.6587. And then year number 5, what do we have? Year number 5, 0.5935. 0.5935. Thank you so much. ladies and gentlemen, what we shall do is to come and do what here, multiply these things very fast for you to give me the present value as I answer the law. The law, remember, what is PVPA? It's present value interest factor of an annuity. Annuity is a repetitive figure. For example, today you're getting 10, tomorrow 10, the other day after tomorrow 10, 10. Repetitive every year. You can see these figures here are doing what here, they are fluctuating. They are what we call lump sums. And that's why we're using PV. We can't use PV per year. I hope that's more explanation helps. So whole number over here, present value, whole number inakuwa namna gani? Okay. So hii inakuja hapa 110 whole number. Ukichukua hii na hii inakuja ngapi? Aha, inakuja 102, 102. Haya, ukija hapa hii number 3, hii number 3, hii number 3 inakuja ngapi? 161, 16, 116, hii number 4, hii number 4, hii number 4. Eric Odinga anauliza swali hapo. As I answer him, please give me hii number 4 inakuja ngapi? 24, 24. Here number 4 inakuja 24, and then lastly we have a 7 times this. This will give me like 4 or something, 4 like that. Aya, Eric Odinga anauliza ile swali ambayo tulikuwa tumefanya hatuku combine. Imagine sio lazima combine hata kwa hii. You can opt in this case to discount your total operational cash flows kando. Uzipate total operational cash flows kando. Tena ukuje uchukue hii 5 ikiwa peke yake, was it 5 ama gani ile? E7. No. E5 ilikuwa scrap. Uchukue scrap ikiwa peke yake multiply na PVP yake alafu ziadd pamoja. That's a good question. You will end up getting the same answer. Same answer. So you can take in this case the operational cash flows with the discount zikiwa kivyao. Tena kuja uchukue scrap value and whatever working capital which is there, you discount ikiwa kivyake alafu ziadd. Upate the present value of future cash flows. Alafu subtract initial outlay. I think tumecombine. Hata ukifanya kando, sijui kwa nataka nikuonyeshe cha namaanisha. Hata ukifanya kando utapata the same answer wewe. Try that at your own time. Utapata the same. Thank you very much. So could you kindly give me the total present value? Please give me the total present value. Give me the total present value. Hiyo ndio mlisema broiler. But here that's 356, and then you come here and less the initial outlay. Initial outlay ilikuwa ngapi ile ambayo hakuna kudiscount? Initial outlay ilikuwa ngapi? 356, thank you. Even Bansi alikuwa amenyamaza. Bansi, asante kwa kuja live. Initial outlay wanasema ilikuwa 250. Fortunately, initial outlay hapa haikuwa na working capital. This was a good examiner. Haikuwa na working capital. How comes present value of year number 5 is positive? How comes it is positive? How comes present value of year number 5 is positive? Ndeka. Kumbuka ile mali tulikuwa tumesema 0 minus ilikuwa tax. And the tax itself was minus what? 7. Tukapata 0 minus, tukapata 7 positive. 7 positive. Yes, check from PAT. Thank you so much. Check from PAT like that. So tunapata NPV is 106, meaning that the project is what here? The project is viable. So is there any student who is able to remember now that you are done this question? Is there any student who is able to remember that you have done the question? Now can you remember? There is a question that Eric Odinga had asked. I've already answered him. Great. So are you able to remember that we did this question? The question number 40, the core. Question number 40. Nakumbuka kweli? Nasahau kwa nini? Tracker company, yes. Yep. You see, they got this 11%, very bright people, tax allowable. You can see net present value here is 106,000. We can clap for ourselves. Net present value here is 106. Our figures were in thousands. So we got 106 exactly. We have tried. We have tried. We have tried. Lost network. Babakeo not kwa normal class, but thanks. At least tumepata hiyo. Aya. Okay. Okay, no problem. No problem. Thank you so much. At least umeona kitu. Babakeo wants me to repeat that how we got the 100. That is really a lengthy working. Is it possible I share with you, Babakeo, the solution here? Babakeo, you are a bright man. Let me just share with you this thing. You should be able to do what? Thank you so much. Now, ladies and gentlemen, kilicho na mwanzo kina nini? Kilicho na mwanzo kina nini? The theory. So, in international finance, I would want you guys to always remember these things. In international finance, you have to be in a position of knowing these terms: Eurobond, Euronote. Eurobond, Euronote. Do you know them? Do you know the difference between a Eurobond and a Euronote? You have to speak very fast. You have to talk very fast. Difference between a Eurobond and a Euronote? Nope. Okay. So Eurobond, don't write because I would want to just direct you very fast. When we talk about a Eurobond, ladies and gentlemen, it's an international bond. We use Eurobonds like Kenya. We have used Eurobonds 4 times. The 5th time in this case here did not materialize because of the changes happening politically, right? So we use Eurobonds to borrow money from abroad. We use the Eurobonds to borrow money from abroad. So these are international what here? Bonds that are denominated in other country currencies. So if it's Kenya using Eurobond, it can't be given money in Kenya shillings. It will be given money in dollars. Is that good for the country? No. Because when it comes to repaying, these money back in form of dollars, we shall have a pressure, a very big demand for the dollars, a very big demand for the dollar. So the price of the dollars will go high. Our currency starts becoming what here? Valueless, right? Right. Does it have any advantages? Yes. In the medium, or rather in the short run, we are getting dollars as well, right? Eurobonds are quite cheap. And of course, you can borrow as much as you want. In the Eurobond, you can get money that you cannot get what here locally here. Money that you can't get locally here. Right? Also, especially when government goes to borrow from outside, ladies and gentlemen, remember when government goes to borrow from outside, they leave SMEs home here to get domestic loans. So they're not fighting for domestic loans with the SMEs. So that is one of the surest way of ensuring, ladies and gentlemen, that these loans are not very expensive locally here. If you want to reduce the interest rate, let the government not be a player in the domestic borrowings. So Eurobond is an international bond, which will be used to borrow what I could call international loans. And they are long-term in nature. Euronotes have the same definition with Eurobond, except for Euronotes are short-term loans. Euronotes are short-term notes, short-term loans. Are we together there? Somebody, you can even take a screenshot of that answer. You can even take a screenshot of that answer. Is that okay? You can take a screenshot of that answer. Is that okay? Again, in international financing, ladies and gentlemen, don't forget the Muslim. Don't forget the Muslim thing that I sang here the other day, that we can easily get, ladies and gentlemen, loans, serious loans internationally, simply targeted for what your Muslim members who are outside there, who are outside Kenya, right? We can get loans from them by issuing what we call a sukuk bond. Sukuk, S-U-K-U-K, sukuk. Usikafikiria ni sukuk ukiona kitu kama hiyo kwa exam. Sukuk bond, right? So sukuk bonds are international bonds. They're international bonds which are Islam-based, which are Islam what? Yeah, Islam-based. Islam, they don't go for interest. Islam, they will basically invest if it's in the Kenyan infrastructure, but they will tell you, out of whatever profits or savings you'll make, we shall be sharing profits with you. Islam is a straightforward religion. When they give you money, they would want to know the specifics. Where is this money going to be invested in? Where is this money going to be invested in? So the biggest advantage with sukuk bonds, ladies and gentlemen, is that there will be quite a lot of reduction in terms of corruption. Because Muislamu anataka kujua pesa yake inaenda wapi. Hautachukua pesa ya Muislamu alafu uende upatie wakora wameiba mfuko yao, wameanza kuenda kufanya vitu fani kwa barabara hapa. Hiyo Muislamu anajua hata enda mbinguni. Muislamu anataka kujua hii pesa inaenda kwa halal. It has to be halal projects. Hataki kitu yote ya brothel, hataki kitu yote ya bar, hataki kitu yote ya gambling, right? Hataki biashara ya nguruwe. So advantage yake ni kwamba countries in this case that raise money using sukuk bonds, normally they end up making better investment decisions because of the guidance, which is what are faith-based. Lakini wengine hawa Kristo tunapeana pesa tu ujali naenda kutumika aje, right? Haujali na naenda kutumika namna gani. So don't forget the sukuk bonds. How about this one, ladies and gentlemen? Very important. Option being in the money. Option being out of the money. Is there somebody who can tell us they're giving me charts here? No, I will not send you any handout after, Mary. I'm sorry. Take screenshots. Take screenshots. Very important. Very important. An option being in the money, ukisikia option is in the money, this is an option that is profitable. There is a gain when an option is exercised. If an option is exercised now, you will make what here? A profit. You'll make a profit. Maybe I've seen your question. I'll be able to respond to it. So basically, thank you very much, Mayom. You are saying that an option that is in the money is an option that is what here profitable. An out of the money option is an option in this case here that will not generate profits for you. Out of the money option is not an option that you can even exercise because you'll make a loss. You'll make a loss. Out of the money options are options that are loss-making, and therefore the holder will not exercise that particular option. So currently, you guys in your lives, which position now would you say you are in? Are you in the money or out of the money? Are you in the money or out of the money? Are you in the money or out of the money? Thank you very much. In the money. Great. Moving out of money. Now, ladies and gentlemen, the other thing that I would want you to take very seriously here, before I remind Emily, those Islamic things, are international finance. You must be able to differentiate between interest rate parity and the purchasing power parity. Do we know the difference between the two? Do we know the difference? Do we know how to define them? Do you know the difference between interest rate parity and purchasing power parity? Let me just finish the questions that I wanted to give to you. Like here in May 2017, they asked students here to explain 3 functions of the African Development Bank. Na wanafunzi wengi kabisa wakashindwa. And the African Development Bank is just like any other bank. It's just like any other bank, right? Banks, in this case, ladies and gentlemen, what do? Banks, of course, we know that the first thing they will do, they will give you a chance of doing what, ladies and gentlemen? The concept of loans, in advance loans to member countries. They'll provide what we call technical assistance. Before these guys give you any loan, they must come and carry out what we call feasibility studies. Feasibility studies. Any bank, at Equity Bank, they normally act as guarantors. They normally act as what here guarantors for member countries. One, for example, kama saizi ukitaka a very serious tender in the government, utaambiwa like bank guarantee. Where do you go to? You go to Equity Bank and buy a bank guarantee, given if your cash flows are nice, right? So any bank, hata kama ni World Bank, remember the concept of loans, remember the concept of, ladies and gentlemen, guarantee. Don't, in this case here, forget the concept of what are technical assistance, even an opportunity of you guys saving, right? Right. Remember, like World Bank, they give you like, they also have these loans where they provide you something like, a maximum of 20% of your share capital. So countries have their own share capital, taking money there. They save, and therefore if they save, they'll also be able to get what your interest income, right? I can see you guys mmesema charts mingi sana. So it's just like any other bank, just like any other bank. Screenshot, okay. Yes. All right. So the same case with the functions of the World Bank. Functions of the World Bank, right? You can see grants loans to a member country of up to 20%. The concept here is that, ladies and gentlemen, World Bank will be advancing loans to member countries. It will be providing what we call technical services. When they come to guide you, chances are you will succeed, right? And that is why, ladies and gentlemen, I normally sympathize with the people outside. The lack of finance knowledge is a problem. Utapata presidential candidate amekuja akasema, at once I come in like this, I'll drop the taxes, the fuel right away. And then what will you do? I'll go to negotiate with the IMF. IMF, straight away, the moment you start making those kind of things, they are very, very particular, right? They will, in this case here, recall all the loan facilities that they have given. Right? They will be the first people, once they take leadership, or anybody who takes leadership here, they'll be the first people to increase the price of what here, the price of fuel. Why? Because you know how IMF will come and dangle. IMF will come and dangle a carrot, and then they'll tell you people, we are feeling that there is a lot of inflation. Like in Kenya, there is a lot of inflation, right? And we would want you guys to take this inflation down by mopping out excess liquidity. They don't want this excess liquid to be there. So they tell you, do this. If it's civil service, sack people from civil service. Your employment book is so much bloated. Sack people there. Number two, increase prices of this, reduce any subsidies that you're giving here. So you can't really blame any president for, in this case here, some of these price increases. Subsidy programs are unsustainable. IMF cannot accept to that. Not IMF alone. Even some of these developed countries, they can't give you any money. They can't give you any money. So it's a high time people start realizing that now Kenya is becoming a global player, a big entity, big like kind of an organization with first world infrastructure, and we must now pay the price. Hata kama itakuwa Raila ataingia, ama itakuwa Ruto, ama Wajakoya, hakuna vile cost of living inaweza karudi chini. I don't know whether there is anybody who lives in a country like Dubai. Yeah, these very well-established countries. You'll be surprised how expensive life is there, because Dubai roads are very good. Everything there is very good. Who has to meet that cost? It is you. It is you. It is you. It is you. The only thing unaweza kuniambia could reduce cost of living ni to ensure that we stop importing, right? Or our importation reduces drastically. We create jobs for our people here. When you create jobs for our people, you shall be able to increase the tax base, etc. It is those things utasiana kwa mtiani, alafu unasema kwani Haura alikuwa anajua kitu na hakutuambia, alikuwa anaongea ni kama ni politics. We shall overcome. We shall overcome. We shall overcome. Yeah, economic advisories, like I like what Eric Odinga is saying here, these countries will come, like right now, they are telling us that we have a problem with our exchange rate. They're saying that we should be having 150 Kenya shillings to $1 currently. So they're saying you guys, you are overvaluing the Kenya shilling is more weaker. You can imagine now what is going to happen when we get this dollar going for 150 and yet we are a net importer. Things will be crazy. Things will be crazy. The government will become bankrupt because of what here the current loans that the government is paying, which are dollar denominated. Right? So the faster we start, in this case, you're saying no to imports, and of course saying yes to anything that is locally made, then that one will be able to entangle ourselves from slavery. We shall be able to reduce cost of living. That is the only thing you can do, and ensure that we reduce on what? Imports. And if possible, also ensure, ladies and gentlemen, that we are able to promote international trade locally here. We should be now exporting. We should be, ladies and gentlemen, ensuring that we encourage what we call foreign direct investments, is a bit. Si tunakataa kama China. Unajua kama China, kupeleka vitu kwa sio rahisi. Wako na very heavy taxes za ku-export vitu to China. But they try as much as possible to be a net exporter. Like they're the biggest exporter globally as we speak. Biggest exporter globally as we speak. Thank you very much. So at least utasikiza, utaenda uangalie. Functions of IMF, functions of what here, World Bank, etc. Right? Like now functions of the International Monetary Fund facilitates the expansion and balanced growth of international trade. IMF would want, ladies and gentlemen, every country to have a positive balance of payment. A positive balance of payment, every country. But you see now countries with the people, leaders who are not very nice, leaders who are not leaders who are greedy. They can't really work in the interest of their people, right? They're the number one in terms of importing, right? Like you see, when you go to countries like Scotland, Netherlands, owning a vehicle is not a big thing. It's not a big thing. I mean, we get a very serious member of the society there, anatembea mguu ama akona baiskeli, like the professors in the universities, akona baiskeli. Lakini hapo utapata mtu mshahara ya 100,000, anataka kigari kikubwa, hata angali mambo ya carbon footprint, right? Anaanza kustrain kulipa malone. What we are supposed to do is to have a good infrastructure and then encourage people to do this cycling, right? At the very best, a rich person should be having a scooter. You know, a scooter. Right. But most importantly, that we should strive to ensure that, you know, like now these vehicles, most of them we are importing. It's very wrong. We keep on importing and yet we are suffering here, right? Our currency is becoming weaker. Our people are missing out on jobs. Very important that we need to really put things straight for us to have a nation that we can bequeath to our children. All right. Now, ladies and gentlemen, we have that promotes exchange stability. That's what they are telling us, that you guys have got to do this and this to ensure that we've got what here, your exchange rate being stable. That's why they give us money to stabilize. They give us dollars most of the times to stabilize our rates, right? Now, most importantly, we're not supposed to forget, remember, International Monetary Fund, they also give us a lot of advisories, technical assistance, and they also give us what here? Loans. They also give us loans. Don't forget that they also give us loans. They give us loans. Very important. So in terms of international financial management, those are the things that I would want you guys to know. Those only. Those things. Yeah, like Canada, the bigger the car, the higher the tax you pay. The bigger the car, the higher the tax you do what year, the higher the tax you pay. Very few people will be owning vehicles in those countries. Other parking, like in the UK, parking utaomba pesa kama 2,000 per hour, Kenya shillings equivalent per hour. Unaambiwa sasa ukiwa na gari wacha nyumbani. So unaona at the end of the day haina maana. But again, they have very good infrastructure, transportation systems are very well organized. Great. Now, ladies and gentlemen, the thing that I would want to emphasize here in terms of international trade is this concept of what here? Interest rates parity. I'm so sure I've done this severally for you. I've done this severally for you. I've done this severally for you. But if I ask, I'm so sure I'll be told, no, you haven't done, so I'd rather not ask. So when we talk of interest rate parity theorem. Interest rate parity theorem. The name parity stands for what here? Please don't forget the same. That if interest rates of two countries are the same, equal. If interest rates of two countries are the same, the forward exchange rate will always be equal to the spot exchange rate. Spot exchange rate will be equal to the forward exchange rate. If interest rates of countries are the same. If interest rate of two countries are what here are the same. Then automatically you'll be able to get what here the spot exchange rate will be equal to the forward exchange rate, meaning that we shall not be having any fluctuations in terms of your exchange rates. So assuming, for example, you're talking of Uganda. Uganda inflation rate is 10%. In this case, ladies and gentlemen, for example, Kenya inflation rate is 10%, the same interest rates. So it means that if we have 30 Uganda shillings today per Kenya shilling, if this is your spot exchange rate, even a year down the line, if the inflation rates are the same, even after 1 year down the line, still the exchange rate will remain the same. That's what we call interest rate parity, interest rate being the same, right? The same case in this case here with purchasing power. Ukisikia purchasing power, you can even write this formula, purchasing power. Ukisikia purchasing power now is all about what here? Inflation rate. Purchasing power is all about inflation rate. You can even go and write this formula that spot exchange rate will be equal to forward exchange rate if now inflation rates of two or more countries are what here? The same. Are the same. All right. Now, ladies and gentlemen, I hope you have taken that high-level explanation. The name PAR should be able to guide you. Purchasing power parity. Purchasing power being the same between two countries, then the exchange rate between two countries will not keep on fluctuating. It shall remain constant. Sasa, naomba unisikize. What will happen, ladies and gentlemen, you will get a question like this. Let me just show you some question here. You get a question like this. Can somebody in this case here try to write for Mercy something? There, I want to believe that there must be somebody who has gotten that thing. Just from this. Can somebody in this case here try to repeat something for Mercy to understand there in your own language? Is there somebody who can try to repeat something there in your own language? In your own language. They're not helping Mwalimu. They're not helping Mwalimu there. Now, ladies and gentlemen, in terms of international trade, you may get these guys giving you this kind of a question. Let me see the charts. Here. Is the same. Great. Parity means the same. Thank you very much. Now look at this question, ladies and gentlemen, here. Using interest rate parity relationship, compute the expected 5-month forward exchange rate as at 31st May 2017. I've done this question for you severally as well, but I would want to do just part one for purpose of international trade. Using the interest rate parity relationship, compute the expected 5-month forward exchange rate as at that date. Is there somebody who can do this question very fast? Is there somebody who can do this question very first? Is there any student who can do this question very fast? Is it a doable question? Great. I like how you guys are able to write those statements there, and I hope, Mercy, you have been able to pick something there. Anybody who can do this question for us? Let me see, the charts are coming in very slowly, very slowly. Thanks, admin. And admin, I've never known your name. I've never known your name. 3 minutes, Sherilyn will have done this. 3 minutes, Sherilyn will have done this. These are very good definition. Very good definition of admin. Very good definition. All right. So 3 minutes are over. Sherilyn, what do you have there, Sherilyn? Sherilyn. This reminds me of Sheraton Hotel in Uganda. I got very good experience there. Sheraton Hotel, one of the best. I don't know whether the Kenyan one is as good as the one that is in Uganda. The one that is in Uganda is extremely good. Emily M says 101.18, a figure which Sherilyn is also getting. Do I have gentlemen in this class? Do I have gentlemen in this class? Saumu, very good. 101.18. 101.18. 101.18. 101.18. Thank you so much. Thank you so much. So from what I'm seeing here is that I should not even do the question. I should not even do the question because students are so good at it. The way the answers are coming, it's only Nancy who hasn't gotten it. It's only Nancy who hasn't gotten it. It's only Nancy who hasn't gotten it. Maureen is also coming up. I'm trying to do it. Okay, great. Great. Now, the first thing that I know you guys have done, you've written down the formula. You are good. You aren't badly off. You have written the formula. You've written the formula. You've written the formula. You've written the formula. It's interest rate parity. It is interest rate parity. Please revise this. It is interest rate parity. Now, your interest rate is spot rate into 1 plus interest of country C. Of country C. Of country C. All over 1 plus interest of country B. You can call them whatever name. You don't have to be like CB. You can give them whichever name. Is that okay? So remember that this is forward, right? Exchange rate. It's forward exchange rate. It's forward exchange rate. This is spot exchange rate. This is spot exchange rate. This is spot exchange rate. So forward vis-a-vis what here? Spot exchange rate. Great. Now, I'll always get the spot exchange rate. I'll always get the spot exchange rate. So the spot exchange rate, when we were entering this contract, what is the spot exchange rate given? What is the spot exchange rate given? What is the spot exchange rate given? When we were entering the contract, the spot exchange rate given here, remember the contract here is entered into on 1st of January 2017 here. 1st of January 2017, right? So the rate existing on 1st January 2017 is the one that I'll pick. 100 Kenya shillings per US dollar. So 100 Kenya shillings per US dollar. So 100 Kenya shillings per US dollar. Unaweka hivi, ndiweza kujua ni gani imekalia ingine. Ni gani imekalia Kenya shillings per US dollar. Hii expression, it will be able to guide you to know which country is on top. So automatically here, I'm able to know that Kenya is the one that is on top. Then US is the one that is in the denominator, US. Right? So Kenya is up. Thank you so much. So in short, hapa naweza change formula yangu niseme it's interest of Kenya, the most beautiful country in the world. All over interest of United States of America. United States of America, one of those countries which are overrated. Yeah. So have they given me the interest rate of Kenya? Let's see. Have they given me the interest rate of Kenya? What is the interest rate of Kenya? So when you look at Kenya, these guys are crazy. They have given me two interest rates. So what should I do now in this case here? Cry? Should I cry? No, I need to know which country am I going to borrow. I need to know that. That is very important. I need to come up with a policy. Remember here, the company exported what? Coffee. It exported coffee, and therefore it is expecting to receive dollars. It is expecting to receive what here? To receive dollars. It's expecting to receive dollars. So it's a foreign receipt. So foreign receipt, ladies and gentlemen, remember that foreign receipt, there is a rule, very important rule. For foreign receipt, there is a very important rule. For foreign receipt, there is a very important rule. For foreign receipt, because it's a foreign receipt you're expecting. It's a foreign receipt. Thank you very much. So for foreign receipt, you shall borrow what here? Somebody. For foreign receipt, you borrow foreign. Foreign receipt, you borrow foreign. What we simply call foreign boyfriend. What we simply call foreign boyfriend. What we simply call the foreign boyfriend. Foreign receipt, you borrow foreign. So you've got two countries. This company here is based in which country? Let's check. This company, Biashara, is an import-export company based in Kenya. So it's based in Kenya. Therefore, they are going to borrow foreign. So they're going to borrow from which country? So in this case here, they shall borrow foreign. So they shall borrow in the US, and then they deposit where? They deposit this money in Kenya. So you borrow in the US, and then you deposit or invest in Kenya. You deposit or invest in Kenya. You deposit or you invest in Kenya like that. Foreign boyfriend, because these are foreign receipt I'm expecting. So the thing to do in the international markets, you run very fast and borrow in the other country. You borrow foreign like that. So America, we are borrowing. Kenya, in this case here, we are investing. We're investing. Right? So is lending the same as deposit rate? Yes. When you lend this money to the bank, you're depositing. Great. Ladies and gentlemen, if that is the case, you have finished this question. So what have you told me about Kenya? You've told me that Kenya, we are investing. So is there anybody who is able to see investing rate in Kenya? Investing rate in Kenya. Remember, investing is the same as lending. Is there somebody who is able to see Kenya is 18%? They are not able to see investing or lending. in Kenya. Is there somebody who is able to see 18%? Oh, yes, 18%. 18%. Thank you very much. Therefore, then this one here will be sport. Sport, which is what here now? Sport, which is 100 into 1 plus interest rate. Lending in Kenya, investing in Kenya is 0.18. Again, in this case here, if the devil is after you, you will forget to prorate because you know 18% is per annum. And then this is a 5 months transaction. It's a 5 months transaction, so you must prorate. All over 1 plus, in the US, we are borrowing. So in the US, we are borrowing. So in the US, we are borrowing. 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 So borrowing in the US, is there somebody who is able to see the rate of borrowing in the US? These guys are not giving me numbers. These guys are not giving me numbers. Borrowing in the US, borrowing in the US, I'm able to see 15%. I'm able to see 15%. I'm able to see 15%. So plus 0.15 times 5 over 12. So please move slowly. Give me the numerator and denominator. So for numerator, what do? You will take 100 times, open bracket, 1 plus 0.18 times 5 over 12. You close. You say equals, you give me an answer. There is a student some time back who was asking me whether this 100 is on top or below. You see here we have over 1. So 1 is the one that is it. 100 is a numerator thing. 100 is a numerator thing. So Sherilyn, amenipatia final answer. Sijui kama ni final answer, lakini na believe amenipea numerator. 107.5. Thank you very much. How about the denominator? Please ensure you're following your body mass very well. Numerator, thank you very much. Please ensure that you're following your body mass very well. So we have here 1 plus 0.15 times 5 over 12. What do we have for the denominator? What do we have for the denominator? What do you have for the denominator? Denominator. Denominator, I don't know. So I'm waiting for you to give me the correct answer. Denominator, Irene, 1.0625 like that. So is this numerator correct? I can see somebody trying to change the figure. The numerator, is the numerator correct? Is the numerator correct? Yes. So when you divide, give us the quotient. So when you divide, give us the quotient. What do we have there? When you divide, give us the quotient. What do we have there? When you divide, you give us the quotient. What do we have there? So when you divide, give us the quotient. What do we have there? They are getting 101.18. 101.18. Please don't forget that concept. Don't forget that concept. Don't forget that concept. And of course, if you're a good student, ukitumia borrowing rate uko wrong, utakuwa wrong, utakuwa very wrong. Don't forget that concept. And of course, I don't have to belabor. If I were you, hii kitu ya money market, ningeshika video moja tu mzuri, niangalie money market sana. Money market, ningeangalia money market sana. Yeah, sio video mingi ya money market. I know you have those videos, isn't it? Money market. Of course, this works together with money market forward contract. They work together. Please don't forget that area. The last area that I would want to point fingers to for you is this area that now I'll give you something to work with. this question. Question ya Kenzel. Question ya Kenzel. Question ya Kenzel. Is there somebody who is able to remember watching any video of Kenzel Limited? It doesn't have to be Kenzel. It can also be, so long as you're able to remember how to get KD, how to get KE. Is there somebody who remembers seeing this question? Let me just take you to the question itself. Amount in shillings at which breaks in the MCC occurs. WMCC. Is there anybody who remembers this kind of a thing? Is there anybody who remembers this kind of a thing? Yes. So I'm so sure there must be students who don't remember this. I would want to take them back to the video. I don't want you to watch so many videos. I've given you a task of watching a money market video. We have this video of how to get these things very correctly. And then now, lastly, for me to you, ladies and gentlemen, is this thing. I've also done this for you. I've also done this thing for you. This one here. This one here. This concept of what here, somebody? This concept of indifference points. We also have a video for this, indifference points. But I kumbuka kweli, it doesn't have to be the exact question. 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 But indifference points is something that I've really taken time to explain. It is something that I've really taken time to explain. It is something that I've really taken time to explain to you guys. Not unless now we provide a video, because you know, at the end of the day, we must bring this thing to a closure. We must bring this thing to a closure. We must bring this thing to a closure. I remember I've asked for that video severally, and I'm not getting, and I may get the question in video indifference point, okay? You know, these videos, I'm so sure even some of you mko nazo. Sini ukweli, kuna mwanafunzi akona hizi video mahali. Kuna mwanafunzi akona hizi video mahali. Mbona mmoja asijitolea azitume jameni? Mbona mmoja asijitolea atume hizi video? Because mko nazo mahali, I'm 100% sure there must be somebody who has these videos. Kumbuka mwanafunzi mzuri ni ule mwana share content, mwana share material, but don't share with people outside there. You share with people in the groups. People have paid us something. You guys must promote your mwalimu. You must promote your mwalimu. You must promote mwalimu. You must promote mwalimu. And as usual, you have always done that. You've always done that. As usual, you've always done that. Kuna wala hawezi kushare. Kutafuta ni shida, be looking for, lazima utapata mmoja ameziweka vizuri sana. Lazima, especially some lady here. Especially some lady here, lazima upate some lady amezipanga vizuri sana. I'm 100%. I'm 100% sure we're in the rush hour. So it means I get them for you then. So I'll take these few minutes left, ladies and gentlemen, to do what here, to get these videos for you. Kenzel, I'll take a few minutes here to get those videos for you. Nizitume hapa. We are overcoming, don't worry. Iya Kenzel. It's very easy. Ukiwatch video yake umeshakamata. Ukiwatch video yake umeshakamata. Ambe 2017. Question number 1b. Question number 1b. Question number 1b. Sawa. Great. So let me get those videos immediately. Niwatumie hizo video. Namna hiyo. Utapita lea. Pana lia NPV inaleta shida. Utapita. Maybe I can add you one video ya NPV pia uangalie. Utapita. Okay. Now, ladies and gentlemen,